Hello, it's Friday, the 24th of April. The last video we did was just before the Easter break, and so we've had a bit of a gap. But strangely enough, there doesn't seem to be that much new news in that intervening period. There's been lots of news, of course, particularly around the conflict in Iran, and two steps forward, perhaps two steps back on the way. The fragile ceasefire seems to be holding. There's a lot of rhetoric from all the kind of involved parties, but generally speaking, there's not been a huge amount of progress in any particular direction over the last couple of weeks. That doesn't necessarily tally with market performance, which has been fairly strong over the last couple of weeks overall, but again with sort of bumps on the way. But in many ways, if you take a step back and look at markets year to date, they've almost shrugged the conflict off. Not totally by any means, but almost. So to give you a picture of year-to-date market performance, you've got a handful, actually a small handful, the Japan's emerging markets, Asia ex-Japans of the world, that are actually up close to double digits year-to-date in sterling terms. UK's up around about 5, and the US and Europe, which are slightly more laggards so far in 2026, they're more or less flat to slightly up. There is a bit of a dynamic shift if we look after the end of February. Let's use that as a sort of proxy for the day the US and Israel started their strikes. From that period onwards, the US is actually ahead of everybody else, with most markets, most majors certainly down around the sort of mid-single digits, but still not a sort of substantial sell-off in any meaningful way. We had that initial kind of shock, but markets have recovered fairly well out of that. So the question is, of course, what does that mean? And of course, crucially, for investors, what is in the price? And it seems likely that the scenario that's in the price today is some sort of muddle through and reasonable resolution. You look at oil price, and particularly the sort of the short end of the futures curve, the stuff that's very proximate. There's a lot of volatility in there, with crude sort of sat around about the $100 a barrel level, slightly above at time of recording, and that seems to be sort of the new floor really, but it hasn't sort of kicked on to the much higher sort of echelons that we talked about in the last video. That's sort of $200 a barrel. So it seems as though the muddle through scenario is very firmly at the front of everyone's mind, but there's no material progress to sort of sit behind that and justify that. I suppose in many ways the interpretation is no news is good news, but there's nothing of substance really for markets to hang their hat on. Looking for any sort of indication of the impact of the crimping of oil supply in particular. There's not a lot of that really coming through yet. What we do see is actually still reasonably solid economic activity. Businesses still in sort of expansionary territory, but of course all these data are backward looking, and there is an argument that a lot of this sort of recent activity really isn't a consumer and a business attempt to sort of getting ahead of the curve when it comes to potential surprises down the track. In fact, looking at consumer activity, there was a significant increase in buying of petrol in order to try to get ahead of the price increases that are expected to come down the track. So the data is, as always, a bit sort of messy and a little bit mixed, but there's no sort of obvious big impact coming through in terms of economic activity yet, but there is some evidence coming through in terms of producer pricing and in terms of consumer pricing of this oil price increase starting to come through, which is likely to continue for the time being at least. All of which, of course, makes the job of central bankers harder. And on the subject of central banks, there's two interesting stories really to focus on there. The first one, looking at the US, we had Kevin Warsh's sort of confirmation hearing this week. He didn't fluff his lines in a sense, continued suggesting that, inflation will come back, suggesting a new measure of inflation, which, presents a new variable perhaps for us all to bear in mind. But certainly the theme, which is not a surprise, of course, which is that, inflation isn't too bad. Interest rates are too high, which has been a sort of a recurring theme from the US government as well, of course. That seems very firmly in play from what we've heard so far from the new chair. Of course, the slight sort of paradox in all of this, whether it be tariffs last year, or whether it be the attack on Iran this year, two sort of major elements of US government's policy over the last couple of years. Both of them in isolation would be thought to be inflationary in nature. They're likely on balance to put prices up rather than down. And so, while there's a desire to get interest rates down from the US government, clearly it's almost a harder job to do today than it would have been if either of those two sort of major policies hadn't happened in many ways. So it's a difficult job for the new Fed chair. Sticking with central banks, the Deputy Governor of the Bank of England, Sarah Breeden, this morning took a pretty unusual step of identifying a lot of different risks that, essentially she believes isn't properly being accounted for in terms of market valuations. Or to put it another way, looking at how stock markets particularly have behaved over the sort of year-to-date period at or around long-term highs, it feels as though there's a lot of good news in the price, despite concerns around growth that the conflict in Iran may result in, despite concentration of valuation in certain markets, not least the US, and indeed despite a big wall of money over the last 20 years or so going into private markets. She mentions private debt in particular. Essentially, the main concern being, of course, that if these all three were to sort of be challenged at once, the impact in markets could be very severe indeed. Of course, nobody has any perfect foresight on these sorts of risks, and we wouldn't profess to either. They are all risks that are worthy of significant consideration, and it's worth sort of putting it in historical context in the sense that we have lots of different challenges coming at markets on a sort of continual basis. These three that are identified are important, and were they all to sort of fall over at once would be pretty profound. Without any sort of perfect foresight, what can you do? I think really this sort of falls firmly into the multi-asset sort of belief system of being diversified, having lots of different returns drivers in portfolios, making sure you're not overly concentrated to any one of these sort of identified risky areas. Be disciplined, invest for the long term for good reason, based on sort of fundamentals, rather than trying to sort of chase short-term narratives and themes which can become overbid, if you like, and overvalued. And finally, the third D, be differentiated. If you are piling into asset classes that are in their zeitgeist very popular, that tends to be areas where hubris starts to take over, and that momentum, which is welcome in many ways, starts to become almost sort of too excessive, and a presage of something sort of more worrying. So being differentiated, having sort of less loved, sort of slightly out of the spotlight markets and asset classes in your portfolio helps with diversification, and will hopefully provide some ballast in times of market stress. That's it from me. Have a good weekend when you get there, and we'll see you next time.